Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 21st of February 2021, and we're looking at asset bubbles and why we should perhaps be concerned. Or should we? Let's take a look. Now, earlier today, we produced our 12th episode in our Bitcoin versus gold and silver series, where we briefly talked about the rise in the Bitcoin price to over $57,000 and its repercussions, one of which being the rise to all-time highs of other cryptocurrencies. And we've placed a link to this video below. Now let's get back to asset bubbles. There are across the world a number of asset bubbles constantly or continuously being inflated. Much of it regional, for example, property. Some of it elitist, for example, fine art and certain collectibles. But one in particular really permeates most of the financially sophisticated economies, and in particular the United States. And of course we're talking about stock markets, or equities. Now, in the last 6 months, we've seen the three main US exchanges, the Dow, the S&P 500, and the Nasdaq, hit all-time highs a number of times. And even now, they're only just a little lower than their previous one. We're witnessing unparalleled investment into equity funds, whether it's originating from major institutions, hedge funds, or private day traders even. Even the quoted companies themselves are buying up their own stock in many cases, with statistics showing that share repurchases have doubled compared with 12 months ago. The more recent rises, it could be argued, is caused by growing confidence in economic recovery from one of the worst recessions in living memory, albeit a relatively short one. Well, at least so far. This confidence is fueled by the expectation of a successful anti-COVID-19 vaccination program, the easing of lockdowns, continuing government stimulus support, and central bank monetary easing, and therefore the provision of cheap credit. Bloomberg reported in the last day or so, quote, up 75% from March, the S&P 500's gain dwarfs all previous bull markets at this stage of the cycle since the 1930s. It's been truly amazing, said Brian Culpepper, a money manager at James Investment Research. Everyone just thinks the stock market is going to go, he added. Whether it's herd mentality or fear of being left behind, that's what you're seeing, unquote. Now, the question on most people's lips is the bubble about to burst? Well, if you listen to the gold and silver pumpers, it was about to burst every year since 2011. In fact, many predicted it would never recover after the 2008-9 recession. Now, none of us have a crystal ball, or at least one that works. However, looking at past trends helps, and also looking at the economic strategies of governments, banks, and firms also help to give us an insight into what is likely to happen. After all, most economic decisions are grounded to some degree on probability theory. Well, the sensible ones at least. And of course you have those looking at trends and those at cycles, all of which, to some degree, assist in at least a reasonable level of predictive analysis. Now, Michael Alrone, Chief Executive Strategist for the US SPDR exchange-traded fund business at State Street Global Advisors, told Bloomberg, quote, I don't think we're at bubble levels yet, but there are certainly some red flags that would indicate folks are all in on stocks and risk. You need that euphoric moment for the bull market to top, unquote. Now, those of us in the precious metal space are very well aware of this. When we've seen in 2011, gold and silver experience a similar phenomenon, when everyone believed it could not fail to buy gold and silver. But often, that is the time when it does. We've seen in equity markets over the decades this occur. And a common phrase in England has been that when a London taxi cab driver tells you which shares to buy, that's the time to get out of the market. Now, last week, the EPFR, a unit of informal financial intelligence, reported that investors poured in some $36 billion into funds focused on US equities, the biggest inflow in more than 2 decades. Meanwhile, it's becoming clear that hedge funds are reducing their bearish bets and puts and raising their bullish investments and calls. Goldman Sachs Group Inc. recently published data showing that net leverage, a measure of industry risk appetite that takes into long versus short positions, climbed to a record this month. Since March of last year, equities have risen in value by a quite astounding $12 trillion. We commented in today's earlier video on Bitcoin that this past week the entire capitalization of Bitcoin touched $1 trillion for the first time. And yet equities have risen by more than 12 times that amount in the past 11 months alone. This equity euphoria is being borne out when one looks at the options markets and further supported by the National Association of Active Investment Managers, whose survey revealed, quote, the most bearish group that typically has a net short position was 80% long in stocks earlier this month before turning neutral, unquote. As mentioned, share buybacks too have increased, averaging in fact approximately $6.9 billion a day, the most since 2006. The EPFR, which conducted this survey, commented, buybacks tend to have a very high correlation with the performance of the S&P 500. So the boom in buybacks is encouraging, unquote. Looking at the 3 main US indices, the past 12 months, in spite of the vagaries of the pandemic, the Dow has risen by almost 9%, the S&P 500 by 17%, and the Nasdaq by 45%. Situation in the UK and Europe is a little different in fairness, in that the UK's FTSE 100 index is down 10% over the year, the DAX index is up 3%, and the CAC 40 is down 4%. However, the Nikkei index is up 28%, the CSI 300 is up 39%, and even the Hang Seng index, in spite of political turmoil that it's encountered, is up 12% over the past 12 months. As long as there is further stimulus available and a loose monetary policy, we can probably expect these rises to continue. Everyone accepts this cannot go on indefinitely, but it is difficult to see why these rises should end imminently. Corporate earnings from some of the larger companies are showing an uptrend, and whilst average price to earnings ratios are historically high, with the S&P 500 averaging currently 39 to 1, we have to bear in mind that back in 2009, it averaged 70 to 1 that year. Now, we're not suggesting for one moment that 70 to 1 will be reached again, and have acknowledged that currently the ratio is around double that compared with the intervening years between 2010 and now. So there is no hard and fast rule there that says it cannot go even higher as it has done in the past. Our own personal calculations suggest that equities still have further to go. But once expectations are either fulfilled or perhaps worse, unrealized, then we can expect quite a sudden correction, which could quite easily knock a third to a half of equity prices, much of it depending on how high they actually reach in the interim. So while gold and silver are languishing currently, and gold particularly appearing to be out of favour, albeit momentarily, and the investment space and headlines are certainly being taken up by the crypto story, we can still see significant funds moving into equities. When this stops, of course, precious metals will benefit. But it may still be up to a year, or even 2, before that really begins to happen. Though we suspect it will be within a year rather than 2. But again, it depends on the level of stimulus and monetary policy. Now, short term, we are more positive silver than gold because of the expected uptick in industrial demand that any economic recovery will engender. And of course, when funds leave equities, which inevitably at some stage they will, one would like to think that gold and silver will be major beneficiaries of those funds. Will the equity market have further to run, or is it literally on the precipice? Do share your thoughts. We review every one of them, although we may not answer all of them. And meanwhile, thank you for listening. Please, if you haven't done so, subscribe to the channel and also take a quick look at the Bitcoin video we produced earlier, and we provide a link to it in the description box below. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.